Thanks for joining us here on Market Call. I'm Morella Fernandez. Brian Madden on the show today, Chief Investment Officer at First Avenue Investment Counsel. He'll be taking your questions on North American equities. You can call us toll-free, 1-855-326-6266. You can also email your questions in at marketcall@bnnbloomberg.ca. Brian, thanks for coming in. We're seeing the markets drop a little bit today after what was a steadier, almost no movement Thursday, which was good. Do you think investors are sort of settling into the new reality of 2025?
Yeah, it seems they are, Morella. Whether they welcome it or not is another story. But certainly, what we're seeing is 2025 starting off with what you would have to characterize as an ironic twist. And by that, what we mean is the clumsy on-again, off-again aspects of the MAGA economic agenda being enacted are really rattling investors, and none more so in the United States, which is the ironic part. The other major equity indices worldwide, pretty much to a one, are all outpacing the S&P 500, and actually most of them are in positive territory year to date. So I think it's a function of just a tremendous amount of confusion and uncertainty is the buzzword of the year, I dare say. Both on the part of households and businesses on both sides of the border. And so, it's kind of gone and boomerang back at the U.S. administration because the impacts seem to be felt most acutely right there in the United States.
Let's talk about this side of the border and what's changing for us on the weekend as we expect, of course, an election call on Sunday. I'm wondering whether that typically elicits a response in the market. Does it get a little bump? I mean, on this particular time, it's another level of uncertainty on top of that deeper level we already have.
Well, that's true, Morella. And, had we been having this conversation a month or 2 months ago, the degree of uncertainty around Canadian federal leadership renewal would have been much lower because the polls were predicting a landslide victory for the opposition. And now, of course, with Mark Carney having been appointed or chosen by his party to lead and thus take on the prime minister role for a time, the polls have basically come around to being neck and neck. So, I think, as for reaction in the Canadian stock market, this is the worst kept secret in the world. We've been talking since the middle of last year about upcoming elections in 2025 in Canada. So we knew they were coming. We knew there would be policy change, regardless of, what stripe of political party ends up winning the election, whenever it's called, probably this weekend. And realistically, Morella, the only plausible direction of change for policy, especially economic policy in Canada, is in the direction of more pro-growth, less red tape, less bureaucracy, smaller government, maybe smaller, tax and fiscal agenda, and generally speaking, positive for investors. So probably the markets will take this in stride, when we come back to trading on Monday after what looks likely to be an election call on Sunday.
Okay, so we'll talk a little bit more about that later in the show. But we're going to take a quick break. Back with Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. Taking your questions today on North American equities. Here's how to reach us. Back in a moment. Welcome back on this Friday edition of Market Call. We're going straight to your questions. Vicky sent in an email for Brian Madden. Here's what her question reads. What does he see for the outlook for Labrador Iron Ore? I've been a long time holder. We'll pull up that line chart in a moment for Labrador. What is your take on Labrador Ore?
Yeah, thanks very much for the question, Vicky. If you mentioned you've been a long-time holder, if you have, you've likely been well rewarded. This has been a great performer over long periods of time. It's not a company, or I should say a royalty that we own at First Avenue Investment Counsel at this time. It does pique the curiosity, and it's one that we would consider owning. Certainly not a household name, but for viewers who might not be familiar with it, this is a business that owns a 7% top-line royalty on the Iron Ore Company of Canada, and further owns a 15% equity stake in that business. It's not the operator. World-class diversified mining company Rio Tinto is the operator, but it's basically a couple of iron ore deposits in Labrador and I believe Quebec as well, and related infrastructure. There's 400 plus kilometers of rail and port facilities. I think what is keeping people on the sidelines with this one is, of course, the obvious implication. Demand for the commodity, the principal use for iron ore is in steel making, and as everyone, unless they've been under a rock for the last few months, knows, there have been tariffs slapped on Canadian steel and aluminum, which is casting some uncertainty towards steelmakers in Canada. Labrador Iron Ore, just to note, has been a tremendous compounder, over almost 2 decades. Since it's been public, it's had a high teens total shareholder rate of return. Most of that comes from dividends. It's an interesting entity in the sense, Morella, that it doesn't pay, as most companies do, a fixed or steadily growing dividend. The dividend is highly variable. It was as low as $1 per share in 2015. And then they had a bonanza of a year in 2021, and they paid out $6 a share. Right now, they're paying 50 cents a quarter, such that the yield on it is about 6.7%.
It looks like they had a bit of a bump last fall before falling again.
Yeah, I think they went up to 75 cents and then they went down to 50 cents. So if you annualize the 50 cents, you get to about $2, which is where you get about a 6-point-something yield on it. We think a more sophisticated approach to predicting the income stream from it is to sort of take a 10-year average of what the dividend is, knowing how variable it is. And so it is about $2.35 a share over a long period of time. And so on that basis, you have close to an 8% yield, which is not far off of its historic norm. It is trading discounted at 3 times book value, below its 5-year average of 3.4 times. And just a fun fact here, the operating asset, Iron Ore Company of Canada, a former Prime Minister of Canada, Brian Mulroney, was the CEO of that business back in the 70s and 80s, which is to say it's a very long life asset with 1 billion tons of reserves. It's producing below capacity. So, we'd give the nod to this one. It's one that you can likely rely on for a very long time. For that steady, maybe not steady, but a slowly growing, albeit with some cyclicality, stream of dividend income.
Got it. Okay, let's get to one more email quickly before we hit the phones. This email says, and it's from Philip, can I get Brian Madden's view on Baytex Energy? Baytex Energy.
Great. Thank you for the question, Philip. We don't own Baytex Energy. It's just over a $2 billion producer of mostly crude oil. About 55% of their production comes from the Eagle Ford Basin in Texas. The remainder comes a mix of heavy and light oil out of Alberta and Saskatchewan. This is a company that did pay a dividend of 10 cents a month until 2015, then cut the dividend to zero, as many oil producers did during that oil price downturn. They've reinstated a dividend of 2.25 cents, I think, per quarter back last summer. They've also bought back about 11% of their shares since that time frame. We don't particularly like this company. It does not generally earn its cost of capital. It's for that reason that it does trade at a discount to some of its peers, whether you look at price to earnings or price to book. It's deeply discounted on a price to book basis. They have been deleveraging their balance sheet to a degree, although it's still a non-investment grade credit rated BB minus, I believe. And the price chart is rather telling. It's down very significantly off its 2022 peak, making lower lows. So stay away from this one.
All right, let's go to the phone lines then and get a caller in before break. Jason's on the line. He's calling us from Toronto. Hi, Jason. What's your question today?
Yes. Brian, question is on the most talked about stock out there now, and that's Nvidia. And I'm a holder. I have a small position. It seems like there's this view and expectation and excitement of the beginning of an industrial revolution centered on AI versus the mundane examination of things like gross margin reductions and disruption by?
Okay. I think there was a question in there somewhere, but I'm looking for it. I guess he's wondering, where are we in the cycle? Because there was so much excitement about Nvidia. It ramped really up. Everybody said it was overvalued. Now it's come down, as many of them have at the start of the year. Where do you go from here? Where are we in the cycle?
Yeah, I mean, obviously this stock has had a strong run. I should say we do own it in our momentum mandate. I've owned it for a long time, and our investors have certainly benefited from it's being at the forefront of the AI revolution. We do think that is in the early innings. Probably it'll be, a long game with fits and starts. We might be in one of those fits right now after 2 years of kind of nonstop vertical on the chart. But this is a company that's just got technological superiority in chips for data centers generally, and AI compute chips. It's the undisputed leader. I think the recent bout of uncertainty emerged in late January when the Chinese large language model DeepSeek came out, highly touted with a model that they train faster and on lower spec chips, which called into question some of the big capital spending plans that some of the hyperscalers have been talking about for the last 2 years. We continue to believe in the long run opportunity for Nvidia mostly, which is centered on AI and data centers now. But they do a number of other things as well that sort of round out the business. And so the stock has had quite a run, but the earnings have moved at least commensurately. And so now, people would often say this stock is expensive. It is less so when you look at it on a price earnings to growth ratio basis. With the PE ratio, I think, having contracted to the high 20s and earnings likely to grow at a similar cadence over the coming 3 years. So we think the pullback is viable here. And finally, just as a postscript, I think maybe last year this was the most talked about stock in the world, but probably it's given up that reigning title to a much more notorious stock or infamous stock, which is now Tesla.
Yes, well, notorious for different reasons. Okay, we're going to take a quick break. Brian is sticking around, of course, to take your questions. He's the Chief Investment Officer at First Avenue Investment Counsel. Your questions today on North American equities. We're back in a moment.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Welcome back to Market Call, and thanks for joining us on this Friday. We are going straight to your phone calls. Michael's been holding on the line. He's calling today from Montreal. Hi, Michael. What's your question?
Hi, Marilla. Hi, Brian. Hope all is well. I just wanted to have Brian's opinion on Air Canada for a long-term hold. I was wondering if he sees it going back to like $30, $40 pre-pandemic levels. And as well, I noticed that Air Canada initiated a stock buyback at around, they started buying it back last year, around $24 levels. And if they bought it then, would they buy at these levels here at $15? Thank you very much.
Yeah, Air Canada really has slid quite a bit. So I was looking up in the last 6 months. It was at that 25, almost 26, down to 15, 11 at this point.
Yeah, I mean, it's, I guess, just to take the bull by the horns right off the bat, for a long-term hold, it would not counsel you to buy this or any other airline stock. Few and far between are the airlines that are, actually good long run through the cycle businesses. And in particular, at this juncture, even for a trade, this doesn't seem particularly timely. The travel is discretionary, particularly pleasure travel. And then the profitable part of most airlines' revenue book is business travel, which I think we can all freely concede is probably not going to make a full recovery to its pre-COVID levels, as we've all learned to do things remotely. And so then it really hinges on the discretionary or leisure travel. And so with the temperature, in the country right now, vis-a-vis travel to the United States, for instance, being at a very suppressed, subdued level, that doesn't bode well. with the Canadian dollar being at some of the lowest levels we've seen in decades, that doesn't bode well for overseas purchasing power in other jurisdictions outside the United States. So then, it would hinge narrowly on a recovery in domestic tourism, which could happen, but probably not enough so to build a strong investment foundation on. So we don't own this. Wouldn't counsel you buying it as well. And finally, just to address the part of the question or the comment about announcing a share buyback, that is potentially a good sign. However, lots of things get announced, but where the rubber meets the road is whether the company actually executes in size on that share buyback. We see these announcements all the time, but what is a better thing to measure and monitor is actual outlays used in the market purchasing back stock. That's the real tell of whether a company sees its shares as being undervalued and a good use of its cash flow. The bet on our part would be it's probably not going to be a big execution on that buyback. Remember, this is not a very financially strong company in the first instance. It has a massively leveraged balance sheet. And of course, the whole spectrum of tariff risks looms out there as well on aircraft purchases and leases and so on. So we would not buy this one.
Got it. Okay, let's go to the phone lines. Andre is on the line. He's calling from Chilliwack. Andre, what is your question today?
Good morning. Thank you for taking my call. Brian, always good to see you on a Friday afternoon in Toronto. Could I get your thoughts, please, on First Quantum? I'd like to hear your analysis. Maybe are you bullish on the reopening of the copper mine? It seems to be quite an active discussion online. I'd like to hear your thoughts, and have a good weekend to both of you. Thank you.
Thanks, Andre, and happy Friday to you as well. This has been a very interesting situation. I'll say we don't own First Quantum Minerals, but are looking at it with renewed interest. We have been watching this situation closely. Of course, as shareholders of Franco-Nevada, the gold royalty company whose biggest asset is a royalty on that Cobre Panama mine operated by First Quantum in Panama that was shut in about 5 quarters ago after a change in government down there. Or I should say a change in the stance on the outgoing government. They had an election last May, and the new President Molino has reopened the file and is engaging with stakeholders in the country to see if they can rekindle the social license to get that mine moving. I'll say that is critical to the go-forward outlook for First Quantum. I think it comprises something like 40 or 50% of their net asset value. But it is equally as critical for Panama as well. This is a mine that opened in 2012 or 2013. It produces 1.5% of the world's copper. It has a massively long, multi-decade reserve life. It accounted for about 5% of GDP in Panama, and directly and indirectly about 40,000 jobs. And Panama has been hurting, not surprisingly, since effectively shooting themselves in the foot and shutting this mine. And Panama could stand to make some friends internationally. Certainly they're going to have a long battle ahead of them over the canal, given the rhetoric out of Washington. So they do need this to bolster their flagging economy and generate export revenues. So we're cautiously optimistic that the logical decision to reopen the mine will be reached, and probably on terms that are at least neutral to First Quantum. So good upside optionality here. It's a bit higher than our risk appetite would entail taking, but for a more risk-hungry investor, there could be outsized upside in this name here, especially with copper prices strong.
But a bit of a waiting period depending on what happens with those discussions.
Yeah, I mean, this won't happen quickly. It was quite a thing when they shut it down, and so I think they're going to walk carefully through this one to make sure they have a broad social buy-in to reopen it.
Okay, let's get to one more phone call before we have to take a break. Kevin's on the line from Kingston, Ontario. Kevin, what's your question today?
Hi, thank you, Brian, for taking my call. It's on the TD Bank. I know they paid their fine in the U.S. and they have an asset cap, but I really believe they're going to emerge much bigger and much stronger with a massive capital base. Would you be a buyer at these levels? The only caveat is the tariffs that are being imposed, and I'm afraid what it might do to the Canadian economy and the housing market? Thank you.
Yeah, thank you for the question, Kevin. Short answer is yes, we would buy this. We do own this company, have owned it for quite some time. We, like probably yourself and others that are investors in the name, were understandably displeased by the breakdown in governance and anti-money laundering controls that precipitated that huge $3 billion fine. But we do think that they have turned the page, and like the previous stock we talked about, it's not going to be an overnight fix. TD, both their outgoing and their new CEO, Ray Chun, have been pretty candid in saying this is going to be a multi-year turnaround to get free of this FTC or DOJ consent decree that limits the growth in their balance sheet in the United States. And it's going to require a lot of investment in systems, processes, and anti-money laundering and compliance personnel. So they're getting after that. We think that is all adequately discounted in the share price. We like the optionality of the excess capital that they are carrying, and that's been further bolstered by the proceeds from selling their stake. Charles Schwab, about a month or two ago, massive proceeds of which they've earmarked the lion's share for buying back their own shares. We applaud that as well because the shares are discounted versus its historical trading multiple and versus the peer group. And we think there will be a sharper focus on the businesses where they do have the social license to grow, notably capital markets, where they bought TD Cowen a year and a half ago, and of course their very strong Canadian personal and commercial franchise and wealth management as well. So, and I should also note they have the #1 discount brokerage platform in Canada, and that seems to be an area where all the banks are putting their elbows out and looking to take market share. TD, we think, has the right to win there. So, like the stock, and would buy it at this price.
Got it. Okay, that's it for TD. We are going to take a quick break. Brian sticking around. When we come back, we'll take a look at his past picks. We're back in a moment. All right, time now for a look at Brian's past picks. His first one from March of last year, March 8th, 2024, was Pool, maker of, no surprise, Pool Supplies, wholesale supplier here. Let's take a look at where it was recommended at, 415 American, down now quite a bit, so 319, so return downwards of 23%, 22% total return. What happened with Pool, or what is happening with Pool?
Yeah, great question. Admittedly, we were disappointed in how this one performed, and candidly, we just got this one wrong. Recognized it last summer, sold it in August, about $345, and avoided some of the latter stages of the drawdown that we see ongoing here. And briefly, what happened? This is a company that sells consumables for pools, so that's fairly steady and predictable. It's not recurring revenue, but it's certainly less cyclical and discretionary than putting in a whole new, big pool in your backyard, which lots of people did in 2020 and 2021 during the COVID era. We initially entered the name thinking that they were coming out of this period where demand had been pulled forward after 2 years of difficult comparisons. And we thought activity would pick up again in remodeling and accessorizing and sort of blinging up pools and installing new pools. A lot of that hinged on a return of consumer confidence and an unfreezing of the home resale market in the United States. That didn't happen on the timeline we had first envisioned, and part of that was due to the Fed being slower to cut overnight rates than what we had foreseen at the outset. So as I said, we sold the stock and moved on. Great company still, but not the right time for the stock.
Okay, let's get on to your second pick at the time, which was Hershey. We'll take a look at where it was recommended, 194.56, again, March 8th, 2024. And now dropping to 166.13, return down 15%, 12% drop in total return. Is this because of cocoa shortage, or was this something else adding to Hershey's difficulties here?
Yeah, it's two things, Morella, and sort of rhymes with the previous one, Pool Corp. This one It didn't work out. We recognized that we sold it in September at about $197. So again, avoided some of this latter stage of the drawdown. And the drawdown really was precipitated by two things. A drought in West Africa, which is where most of the world's cocoa comes from, Ghana and the Ivory Coast, which drove prices up to, I think, $13,000 a ton. And for context, cocoa had normally averaged between $2,000 and $3,000 a ton for years, if not decades. So that was quite a cost pressure for them to absorb. And then finally, after years of inflation in food commodities in particularly, which they, because of their iconic brand, had successfully passed through to consumers with price increases, finally we started to see the cumulative effect of those price increases start to bite and what economists would call elasticity kick in, and people started reducing their unit volume purchases of chocolate. So we threw in the towel and put our capital elsewhere in a better idea.
Okay, let's get to your third pick, which a year ago was Shopify, very well-known name. Shopify at the time was $102.87, now at $147.31, so a solid return, up 43%. 43% as well for total return. Shopify is still doing well, still expanding?
Oh, it's expanding by leaps and bounds, Marilla, and so we continue to own this one. We're pleased with how it's performed. If anything, the pullback that a lot of these high growth and tech names have had since January, and a name like Shopify is a great opportunity to add to it. But briefly, this is a company that has just dominated the e-commerce enablement space for certainly the last 10 years that it's been a public company, but really the last 2 decades, dating back to its inception. And they basically offer e-commerce in a box and e-commerce enablement for small and medium-sized businesses and increasingly large enterprise scale customers now as well. The likes of Adidas and some of the luxury brands use them. So they continue to grow, and most compellingly, they continue to invest in R&D and deepening and broadening their capabilities. So their second stream of revenue is sort of attachments or add-ons to the core subscription revenue for enabling e-commerce. So things like payments is a big growth vector for them, and they've only really switched that on in a handful of countries, and over time plan to grow that to 30 or more. So their take rate on gross merchandise value has grown from, I think, about 1.5% when I started following this about a decade ago to close to 3% now. And the big secular force that's propelling it above all within the sector is the secular rise in e-commerce penetration within overall retail sales. And we think we've still got lots of room to run on that clock as well. So like and continue to own it here.
Got it. All right, we are going to take a quick break. Brian will stick around and take more of your phone calls and your questions when we come back. We're back in a moment. Welcome back to Market Call, and thanks again for joining us. We want to get right back to your phone calls. John is holding on the line. He's calling from London today. Hi, John.
Hi, Marilla. Hello, Brian. My question's on the aerospace industry. So the cost of launching satellites is exponentially declining, and the need for satellites is exponentially increasing. I'm going to call that Goddard's Law after the founder of rockets. What do you think of MDA Space in Canada? Or actually, my question is on GE Aerospace in the U.S. I'm a longtime holder of GE. Is it time to add? Thanks very much, Brian.
Yeah, great. Thank you very much, John. I was expecting a question on a different company, and have to confess, we don't own MD Aerospace in Canada. I've owned it previously, but the company's gone through a number of transformations. I believe has redomiciled itself to the United States since then in order to better be able to compete for military and top secret clearance kind of work. And GE Aerospace, really have to say, regrettably, haven't done the work on this one. Although at a high level, I would sort of commend GE for sort of taking the steps to unlock value in some of these operating units and position them as standalones. Often when companies are broken up or spun out, they can be outperformers as they have a newly empowered management team. They don't have to compete for capital with other operating units, and they get valued as pure plays in the market rather than as conglomerates that trade as some of the parts. So with apologies for the admittedly superficial look at that one, but I wouldn't want to go any deeper and mislead you.
MDA was headquartered in Brampton. Are they still in Brampton, do you think? Or do you think they're expanding in the U.S. just because that's where some of their contracts are obviously coming up?
Well, as I understand it, what they have done is, and a number of companies are taking steps to do this, most notably and controversially, Brookfield Asset Management redomiciled to New York. Of course, Prime Minister Carney is taking some flack for that, deservedly or undeservedly. But, in a lot of cases, this is really just papering up an office in another jurisdiction in order to qualify for index inclusion. I don't think that was the motive in the case of MDA. I think this was sort of a national security and top secret kind of clearance contracts that precipitated the decision. So as best I understand it, that's what they've done. But the mine, the management, the intellectual property, the jobs, the taxes payable, to a large degree, I believe, continue to reside in Canada.
Got it. Okay, let's get to our next phone call. Dave's calling from Toronto today. Dave, what is your question today for Brian?
Oh, hi. I'm calling about Allied Properties. Are you bullish, and would you buy it? Thank you.
Thanks, Dave.
Thanks for the question, Dave. We are bullish. We would buy it. We do own it. Continue to like it here. This is a stock that was a darling pre-COVID. It was one of the best performing real estate companies on the TSX Composite. COVID really knocked the wind out of their sails. As you might imagine, the portfolio is very heavily skewed towards office. That's about 85% of their gross rent. Remainder is largely retail and some parking. The geographic focus is heavy in Montreal and in Toronto. This is the company that is renowned for rejuvenating the formerly derelict old garment and warehouse district along King West and turning it into very innovative and desirable office space. But occupancy levels are running around 85% versus about 96, 97% pre-COVID. So that's depressed their funds flow from operations and the share price. So, we added this into our dividend growers mandate back in September of last year, not far from these levels. We believe the dividend is secure, although it conceded probably won't grow for the foreseeable future. The company is shedding non-core assets and we believe should attract a re-rating because it trades at about 40 cents on the dollar of its book value or audited value of its portfolio, whereas private market transactions are going off at about 0.6 and 0.7 times book value. Big ones being Brookfield Properties, which was privatized by the parent co about 4 years ago, and another one, Cominar REIT, similar sort of situation. So very undervalued stock, yielding more than 10%. So we like and own this one, continue to buy it here.
Got it. Okay, let's get another caller in. Dana is calling today from Regina. Hi, Dana.
Hello there. My question today for Brian would be on TFI International. Just wondering, it has operations obviously all across North America, through the States and Mexico. I'm just wondering and obviously it's been corrected down quite a ways in the last little while. I was just wondering what the outlook would be going forward, and in light of the tariffs that are coming, obviously, on April 2nd as well. Just where do you see the price going from here? Thanks.
Yeah, so they took a hit, of course. Well, they were another one that said we were going to move to the U.S. Donald Trump is making a big call out to all businesses to come and put their headquarters there, and they decided they were going to go and then backstepped. Yeah,
so this is a really interesting one. You're right, Marilla, and thank you for the question, Dana. So we do own this company. In fact, I had named it as the top pick last time I was on the show on February the 28th. So, this is a company that is best of breed or among the best of breed in North American trucking. Headquartered still to this day in good old Canada. They heard the message loud and clear from their shareholders who protested the decision, which really was driven by rational considerations, qualifying for index eligibility in the United States. And of course, there's a medium-term plan to separate this company and spin out their less than truckload division. And I think to their credit, the board and CEO Alain Bedard listened and backpedaled on that decision to redomicile. But this has been a tremendous compounder, a great serial acquirer in a company or in an industry where organic growth is low. They've done, I think, 80 acquisitions, accumulating to billions of dollars over a decade. Sometimes they buy fixer-uppers. Sometimes they turn them around right away. Sometimes it's more of a struggle. One of the big acquisitions they did was they bought the UPS less than truckload business in 2020 or 2021, and they're still trying to get that one up to their operating standards. We believe they'll be successful. Proof is in the pudding. The stock is up something like 16,000% since the turn of the century. So you buy good businesses on sale. That's exactly what we did, adding to it last month.
Got it. Okay, we do have to take a quick break. Brian Madden sticking around for your questions. We're back in a moment. Welcome back to Market Call. Thanks very much for joining us today. Let's go right back to your phone calls. Nazar is on the line. He's calling from Toronto. Hi, Nazar.
Oh, hi, Marilla. Hi, Brian. May I have your thoughts on Bank of Montreal, please? It has been range-bound at around $140. With fears of tariffs and consequent recession, this bank's exposure to commercial lending in particular can pose a significant problem, as I understand it. Your thoughts on BMO, please. Thanks very much.
Thank you for the question, Nazar. We do own BMO. We've owned it for quite a long time in our dividend growers mandate. Comfortable owning it here. Do take your point, though, about the exposure to commercial lending. This bank has one of the bigger exposures among the Canadian Big Six banks to commercial lending, particularly in the United States. We certainly know that the amplitude of the credit cycle in the United States is bigger than the amplitude of credit provisioning in Canada. Just to say the highs are high and the lows are probably higher as well. Or maybe stated differently, Americans are just less creditworthy than Canadians. However, that said, we think the credit cycle is in the latter innings. Credit cycles follow interest rate cycles like night follows day. So when the Fed started hiking overnight rates and the Bank of Canada at the unprecedented pace starting in 2022, we were owning this and the other banks with eyes wide open, knowing that there would be an uptick in credit provisioning, especially after the anomalous negative provisioning that was done in 2021. So we think most of that's behind them, and that was vindicated by their most recent quarterly results that came out just about a month ago. So we think they're adequately provisioned for foreseeable, credit provisions and credit losses, both in household and business lending. And so reasons to be confident as a shareholder. We like the synergies that they're getting after with the Bank of the West acquisition they did just about 2 years ago in the U.S. Their wealth franchise is excellent and growing, fee-based, not particularly vulnerable to credit cycles, and their capital markets business is formidable and also growing quickly. They've got a very strong balance sheet, and so we expect the normal growth algorithm for Canadian banks will apply here. You get a current income measured by the dividend yield that's in the mid-single digits, and they'll probably grow that dividend at a mid to high single-digit pace over a cycle. And you put the two together, good line of sight to a low double-digit return in this. And so we think today's as good a day as any to own and add to BMO, tariffs notwithstanding.
Got it. Okay, let's quickly get to Blake calling from Fort Francis. Blake, what is your question today?
Hello, Brian and Marilla. Thanks for taking my call. It's regarding Canadian Tire. I see it slowly rising up. Is that a knee-jerk reaction to the U.S. situation, or is it just a well-managed company? Is it worth a buy now?
They're going through a lot of change too, right? They're going to shutter some stores under their umbrella. They're going to pull some brands into stores, and the standalones will go away.
Yeah, I think they are rationalizing. They run a number of banners. Of course, it's best known to Canadians for the iconic Canadian Tire stores, but they own Mark's Work Warehouse, and I believe they brought
Atmosphere.
And then they own some product brands as well, like Helly Hansen, I think, is one of them, and a few others, Noma, outdoor and electrical lighting, and so on. We don't own this. I would maybe differ that it's a superlatively managed retailer. We own a number of other retailers in Canada that we think are better. This one is okay, and it's gotten better over the last decade. But the crux of the concern here is that it is substantially all discretionary purchases. And we do observe, in fact, we saw just with the Canadian retail sales report this morning that retail sales are slowing, household uncertainty is on the rise. And a lot of this stuff that they merchandise is traded and may be susceptible to tariff risk. So we'd sidestep this one for the time being.
Yeah, they have been talking about trying to find more Canadian suppliers like everybody else has. I think they sold the Helly Hansen brand in the end because they weren't promoting it internationally well or something like that. But we can talk about that in a moment. We are going to look at our guest top picks when we come back. Stay tuned. Welcome back. Brian Madden is here with his top picks. We're going to head with that. His first one is a familiar name, been in the headlines a lot lately, and that is Couche-Tard, which is in, I'm going to say, discussions, but it's not really clear how much discussion is going on with the Japanese holders of 7 and 11. So you like this company?
Definitely, Marella. And the name of the company in French translates into food for night owls. And we're not just sure how well that translates into Japanese, but we do know the founder, Alain Bouchard, and the executive team have been on a charm offensive in Japan in recent weeks and are continuing to engage in friendly fashion with Seven and I to try and acquire the company in whole or in part. We're rooting for them. They're excellent acquirers, serial acquirers in this very fragmented industry, financially disciplined, and so we think there's a sensible deal to be had here. The market agrees with the Seven and I shares trading about 20% below the price that they've offered. Nevertheless, our constructive outlook doesn't hinge on them necessarily succeeding, although we'd like to see that happen. What you've got here is the second largest convenience store chain in the world, 14,500 stores in Canada, the US, Europe, and Hong Kong. And briefly, the strategy is to price sharply on fuel to draw traffic and then lure shoppers into attractive, modern, well-merchandised stores where they sell merchandise that carries gross margins 3 to 4 times higher than what they earn on fuel. And they're upping their game in food and prepared food. They're now allowed to sell alcohol in Ontario, which has helped their same-store sales. So this is a company that's very profitable, almost a 20% return on equity. It's grown its earnings at 12% compound rate over the last decade. It's pulled back in the last year or so. It's trading at an undemanding multiple of about 16 times earnings. So we really see a great combination of value and growth here.
Why do you think they're handling it this way? And maybe this is what they do historically with the friendly kind of takeover talk instead of going in a little bit harder. Is just historically, is that what they do?
Most of the time they're acquiring smaller entities. I don't recall too many instances of them making big public hostile takeovers. But remember, Japan is quite different than North America. The corporate governance culture is evolving there, but this is not a place where activist campaigns have really taken root in any meaningful way over time, except it's picking up in the last couple of years as they enact corporate governance reform. And so it's just part of the Japanese culture, and I think they'll likely get to a better outcome if they get to a friendly deal, and we do think there's a deal to be had here.
All right, let's move to your second pick, which is Vistra out of New York, which did take a hit, I guess, same time a lot of stocks took a hit this year, start of the year. They were at one point at 190, now down to 129. What do you like about them?
So you're right, Marilla. This stock has had quite a pullback, which we think affords an excellent entry point. I think the big story here is this is sort of a second derivative trade on the AI revolution. It's a leading independent power producer in the United States, serving about 5 million customers across 20 states, including 15 that are competitive and unregulated. Half or so of their power generation capacity is in Texas, which is ground zero for electricity hungry data centers, current and future planned. Upcoming catalysts that we foresee here are it's likely they will sign a power offtake agreement with a big hyperscaler or data center operator, as others have done. Higher power prices, given tight market conditions, should bolster the results, and we can foresee potentially an upgrade to their BB credit rating, lowering their cost to capital. And finally, this stock with the pullback is trading at a fairly undemanding 10.5 times enterprise value to EBITDA, which is actually discounted versus its largely slower growing U.S. utility peers.
Got it. Okay, let's get to your last pick then. KKR also trading in New York. Tell me about, they're an investment space, but an alternative one?
Yeah, that's right. So think of this as being really the granddaddy of private equity shops. They used to call them leveraged buyouts in the 70s and 80s. Now we call them private equity. So an American version of Brookfield might be a familiar way for Canadians to conceptualize this. It went public. It used to be a partnership. The IPO was in 2010. Shares have been an 18-bagger since that time. They've compounded their assets under management at an 18% compound pace since that IPO. They now manage $640 billion. A lot of that growth's been organic, but they did bolster the organic growth with the acquisition of Global Atlantic fairly recently. And that takes them into insurance and annuities. They also have a rapidly growing capital markets business. And the real sort of secular advantage here is private market asset flows are outpacing public market flows. We expect that will continue. So very timely entry point, we think.
All right, something to think about on the weekend for investors. We have to leave it there. Brian, thanks for coming in. And we'll see you again on Monday. Thanks for joining us.